What Jamie Dimon said, you talk to a lot of these CEOs, you talk to boardrooms. Is that reflecting a broader sense in American business?
David, unfortunately it is. I think there's a rising level of frustration. We had optimism early in the year, and now we're sitting here in July, and there's a recognition that a lot of the promise of what we wanted to get done, tax reform, infrastructure, just isn't gathering appropriate momentum. Yet you have the market at all-time high, 3 points on a multiple higher than the past 5 years average. You have growth, according to CBO, at 2%. Fundamentally, that optimism needs to be turned into something real for that to be sustained. And clearly the frustration that Jamie Dimon expressed on Friday really is quite broad.
So if the frustration is broader than just Jamie Dimon, how is it affecting business decisions, investment decisions, decisions to buy and sell, things like that? Is it having real effect in the real world?
Absolutely is. I think today you would have expected, for example, in my world, M&A, we went into the year with certain projections saying it would be a record year, over $4 trillion of M&A. Fact is, it isn't. And the biggest deals in particular, the deals over $10 billion. You've seen the volumes be half of what they were a year ago. And a lot of that is based on certainty of decision-making, confidence in where we're going to go next year, 3 years. Remember, when you do things, when you make investments, you want to have a good tailwind 12 months, 18 months following that investment. And I don't think there's enough confidence today that we've broken out of a 2% growth world. Therefore, getting these reforms is important. I finally would say, David, that there's also frustration that if we don't start getting the dialogue going by this fall, you start to run into the election calendar of 18, and we should assume that it becomes even that much more difficult.
So you mentioned it's not at all clear we're going to break out of 2% growth. In fact, we're running something less than that at period right now.
Yeah, we are, correct.
How do you account for the two things you said, maybe less than 2% growth on one hand, on the other hand, the markets are all-time highs. Where's the disconnect there?
We're all trying to figure that out, but that's been going on for a while. But clearly, asset financing cost low, alternatives for investments low. There is a general stability, and there are pockets. The world is actually in a pretty stable place, if not a growing place, robustly a stable place. You have Brazil and Argentina finally attracting outside capital. You have Europe growing 1.5% again. You mentioned China earlier. There is a sense that globally we're in an okay place, but not the kind of place we want to be in if we actually want to get not just employment growth, but wage growth and general economic uptick.
Jamie Dimon, in his remarks, expressed frustration. He's gone to Argentina, he's gone to Israel, he's gone around the world. Other governments seem to get the practical pro-growth strategy. If you were going to advise President Trump today on the one thing he should do to really increase real growth, what would it be?
So I would be very focused on exports. The fact is, if you look at our manufacturing base, 9% of our manufacturing base is for exports. Go to Germany. They have almost 30% of their manufacturing base for export. It helps create jobs. It turbocharges the economy. And we're not doing that. Any of us in the business community is all for fair trade and everybody playing by the same rules. The fact is, we do need trade, and we need to be in the mix. We don't want to be in a position where Japan and the EU put together a trade agreement over cars, reducing tariffs for Japan's cars 10%. We don't want to be in a position where China has more investment now in Africa than we do. Fundamentally, maintaining our position globally, I think, is essential.
So talk about the practical pressures that this slow growth imposes on a company. Let's talk about, for example, Procter & Gamble. They're in the news just today with Nelson Peltz and Trian going to apparently have a proxy war, the biggest, I'm told, in history, because it's a very, very large company. Does this slow growth put pressure on a Procter & Gamble, for example, because it can't grow faster because the overall GDP is not growing faster?
I'm going to put Procter & Gamble here for a different reason. You might imagine. But
I could speculate.
But more generally, I think when you're not getting top line, you're getting much more productivity below the top line, which means cutting back on investment, doing anything you can to boost margin. Now, you want to be able to have that margin to reinvest in the business so you can get growth. But if you don't believe you have the underpinnings of growth, then it's very hard to make that decision. So fundamentally, I think it is quite difficult, the cycle we're in. And companies have been very nimble, David, in figuring out how they will go about creating their own growth. Most companies today, certainly the biggest companies, are very local. Wherever they are, they act locally. Apple has 22% of its sales in China, double 10 years ago. General Electric has 30,000 people in China, primarily doing aviation, doing engines, where they have a 70% market share. It's not about wage differential, it's about manufacturing locally for local markets. Works for bigger companies. Unfortunately, for a mid-sized company or a smaller company who doesn't have that resource, getting growth is even more difficult.